You manage money for retirees
Yes.
and target funds and so forth, but nevertheless, even if it's far off that you're managing money for to a large extent, you have to be keeping an eye on current conditions. What's most concerning to you about the climate right now?
Well, there's a couple things that we think about. So yes, while our end goal is investing for people that are retiring at Voya, we think about things over the short term and the medium term. So over the next, say, 3 to 6 months, and also over the longer term. So geopolitical tensions that we saw just spike so quickly last week, of course, goes right to the front and center. For us, things that we don't think are being appreciated by the market is the strength of the earnings cycle. Positioning, you haven't seen fund flows, big fund flows into equities this year. It's been much more skewed towards bond funds. That is not a sign of a major market top. And we think that the easing of financial conditions over the past year, which Dudley from the New York Fed had talked about in his statement yesterday, very easy, which are very supportive of growth and inflation over the longer term.
So you're not so constructive fixed income right now as opposed to equities. If not, why not? Because everybody else seems to be.
I know. So fixed income, we have long believed that the term premium that's baked into longer and dated portfolios, it's negative right now. And that is not a normal state of the market. Additionally, the Fed's going to start to roll off their $4.5 trillion balance sheet. The ECB probably isn't all that far behind it in announcing some form of quantitative tightening. That may mean that there have to be other buyers of last resort, which we think yields will drift marginally higher. We don't see that the 10-year will probably be able to go much above 3% over the longer term, and we're looking for something closer to 2.75 for this year.
Barbara, where do you put the probability of recession in the US?
Oh, that is such an important question. We have a Probit model that we look for the probability of recession. It is currently at less than 5% over the course of the next 12 months. And the reason that we watch recessions or for recessions so carefully is because we know that those big peak to trough declines in equities are associated with recessions. On average, a recession will cause a peak to trough decline of equities of about 25%. So we look for them very carefully and if they're getting priced into the market. But right now, we have a still positive sloping yield curve, very well behaved credit markets, and lots of global liquidity.